Good evening. My name is Rick Mason. I'm the professor for the course Advanced Corporate Finance. Welcome to the first of our video lectures. This video lecture is entitled Finance 101, or Everything I Need to Know About Finance I Learned in Kindergarten. As you are by now well aware, you have a very thick textbook and a very thick lesson note manual to go through for this course. However, in this short little video log, we'll go over the 5 principles of finance that you need to master, and if you do master, means that you will master finance. Principle number 1 of finance is cash is king, or if you wish, if it don't jingle, it don't count. Unlike other fields of business, which concern themselves with things such as earnings or profits, or efficiency, etc. In finance, our ultimate objective is to focus on the cash. Now, the thing to remember about cash is that cash is scarce. Whatever you do, remember, cash is king, or if it don't jingle, it don't count. Principle number 2 of finance is risk is the possibility that bad or good things may happen. Notice that there are 3 components to this definition of risk. The first component is a component of uncertainty, in that we don't know what will happen. The second component is an element of the future. Risk is what happens in the future. Finance is a forward-looking field rather than accounting, which is a recording of the past and a snapshot of the present. The third component of risk is the possibility of an upside and a downside. Risk is not simply that bad things happen. Risk is that bad or good things may happen. The third principle of finance, from everything I need to know about finance I learned in kindergarten, is the greater the risk, the greater the expected return. You'll notice that in this sentence, I'm using the word expected. In other words, the greater the risk means that you should expect a larger return, not necessarily that you will get a greater return. This is the basis of all rational decision-making in finance, and indeed in all of business. Unfortunately, finance and business is not always 100% rational, but in finance, we assume to the best of our knowledge that people do try to be rational. The greater the risk, the greater the expected return is a principle that we see borne out in the returns of bonds versus stocks versus government treasury bills. It's also what we see in terms of securitization, and in terms of what we see in terms of variable versus fixed rate mortgages. The greater the risk, the greater the expected return. The fourth principle of finance is the time value of money, or if you will, $1 today is worth more than $1 tomorrow. A closely related sibling of this is the net present value principle. Basically, $1 today is worth more than $1 tomorrow for a variety of factors. Namely, the ability to consume today is considered by most rational human beings a more desirable trait than the ability to consume tomorrow. But also risk, credit risk, and various other factors such as inflation come into this principle. The fourth principle is the time value of money. The fifth and final principle of finance is putting together and intercorrelating the first 4 principles of finance. In other words, what finance is about is looking at the cash flows, the riskiness of the cash flows, the timing of those cash flows, and what the time value of money of those cash flows are going to be. Got that? Nah, not enough cash flow for the risk. Textbook, and you have a very big manual. However, all of this, you actually...
I'm sorry. It was really hard not to laugh.
For this book, for this course, the business, all we concern ourselves with is cash. Can we start that? But it means that you should expect a rational return. Is worth more, and its evil twin sister, I don't want to say that, is tying together the first, I forgot.